Good morning. It is Wednesday, March the 11th. Here is what is on the agenda. The IEA reaching for its oil bazooka. JP Morgan takes aim at the cockroaches. And AI demand powers Oracle.
Tom, let's check in on the oil price. The general direction over the last 24 hours has been downwards, but we've also seen volatility driven by the actions versus rhetoric from the US and Israel, also by the social posts that were and were not sent with regards to the Straits of Hormuz. Euro Stoxx 50 futures pointing downwards, down 0.3%. We've got earnings stories to factor in, but the oil price and everything that's happening over in the Middle East still front and centre. US futures pointing a little bit higher. We've had the Oracle numbers. We also have CPI to focus in on later. The countdown to the opening trade starts right now.
Welcome to Wednesday, everybody. It's just past 7 a.m. here in London, and we have to start the agenda once again in the Middle East with the latest on oil. So it was a choppy day for oil yesterday. We have crude set for its worst week since June of last year, which was, of course, the last time the US struck Iran with missiles. We had oil dropping on this IEA report that you flagged, Tom, this Wall Street Journal report that the IEA is proposing the biggest crude reserve release in its history. And we also had oil dropping to a session low on a post by the US Energy Secretary Chris Wright that the US Navy had escorted an oil tanker through the Strait of Hormuz. But it turned out Wright was wrong.
Yes, indeed. The Energy Secretary, Chris Wright, was wrong on that. Think about the market ramifications of that tweet, of that post on social media from the Energy Secretary, suggesting that there had been this naval escort through the Straits of Hormuz. Think about how much money was lost or won on the back of that. Pretty significant. The remainder, or at least the reminder for the markets, is President Trump can call an end to this conflict if he wants to. But what he can't call an end to is the disruption around the Straits of Hormuz and the attacks on infrastructure in the Middle East. And that is where the markets remain laser focused. We've been hearing about stories about potential Iranian mining ships that have been taken out by US forces. And now you have the IEA readying these reserves. Interesting, I thought, to hear from Geeta Gopinath, former chief economist of the IMF, saying that she is already modelling oil at $75 a barrel. Most forecasts had $65 before this conflict, and what that does for inflation up, growth down.
Yeah, and we'll talk a lot about that through the programme, won't we? We're going to hear from the IEA, or we're going to hear from the countries that asked the IEA to do this work later on today as to whether they want to actually release these reserves. But that certainly there is this reporting from the Wall Street Journal around the number we might get. Interesting on the mining story. I mean, President Trump has been very active on social media talking about what he wants to see happen, and basically doesn't want mines in the Strait of Hormuz, and he wants Iran to not drop any. We have a really interesting opinion column from somebody who used to be, he's a retired US Navy admiral. He's saying to do this properly, because some of these mines will be floating mines, could take months to actually, if there are mines in the Straits of Hormuz, to remove them could take months. So that's something we're watching. We're also watching because the UK Navy has said a large ship has been hit just off the coast of Oman. It's evacuating. There's a fire on board, but just an example of the things that might be happening and that we have to keep an eye on.
But that's the point, the complexity of trying to open up the Straits of Hormuz.
As narrow as it is.
Narrow as it is, and given the fact that Iran still has capabilities near to that waterway, and the complexity and the difficulty of doing that versus the simplicity of declaring victory in this conflict.
Shall we talk about private credit? Because this is another area of focus for us over recent weeks. We have this story, the FT carrying a story that JP Morgan is marking down the value of some of the private credit loans, in particular to software companies. It's interesting because this comes in the context of what we've seen from others in the space. So, of course, BlackRock capping at 5% some of the redemptions they would do, and the sector welcoming that, saying that's good, that's a precedent we like because it gives us the ability to sort of stand behind that. PIMCO saying that this is all about bad underwriting. They're saying that that's the source of all of this problem. But JP Morgan, of course, the source of the quote around cockroaches, Jamie Dimon was the person who said there could be other cockroaches when talking about credit of all sorts, not just private credit. But it does prompt questions about what kind of links we might see between what's going on in private credit and the public credit markets.
Yeah, cockroaches in Jamie Dimon's own house now. We also have to flag Cliffwater. You said that there are lots of others in this space facing the same problem. problems. They've got redemption requests over 7% from the flagship private credit fund. So another firm facing this investor exodus because of the concerns about loan quality, but also, as you say, because of the exposure to software companies that could be disrupted by AI.
And you build that on top of what happened to Tricolor towards the end of last year, fraud allegations. You build that on top of what's happening in terms of double pledging, companies like MFS here in the UK, the exposure to the bigger banks as a result of this. And that is the question, is this still contained to private credit, or is there a bigger systemic risk from this?
Yes.
You need to go back to 2007, and there were examples of gating. There were examples of redemption funds leading up to the financial crisis. We're not there yet, but is this contained? Those in the industry say this is all contained right now, but how long does that remain the case?
The examples you quote, not all private credit, some of them are wider on the credit space, but also the whole concept of gating is a part of the private credit market. So when we see that happening, should we be alarmed, or should we say this is good because it stops a fire sale and this is safer for other industries? Although interesting that PIMCO says that the lack of transparency in the private credit space does make this worse, because you get bad headlines, nobody knows exactly how far they go, and so it ends up being more negative in terms of the market's take.
Cliffwater saying the sentiment's driving the broader sell-off more than the fundamentals. But as you said yesterday, Anna, when private credit says it's a feature, not a bug, of course they would say that about their own space.
Worth noting, I think, that Cliffwater was given an A rating by S&P back in November, noting strong asset quality and cash flow. This is all about concerns, of course, emanating from what's happening in terms of the disruption of the software space. We have a reminder of the power that continues to be driven through when it comes to AI demand with Oracle. And this is a company, of course, where there has been concern about how much they've been spending to meet that demand. But that demand is clearly still there, and that was articulated by the numbers that came through from Oracle. So revenue at that key infrastructure unit that powers that AI demand for customers like Meta, like OpenAI, jumping 84% above the estimates to almost $5 billion US. Yes, the capex spend is there, and in fact the capex spend came in higher than expected. But this is a reminder that the demand for AI services, particularly in this world of agentic AI, is very, very strong.
This is a business, of course, that has been pivoting towards cloud infrastructure. Yeah. It does have a lot of business still, old school Oracle in software, which is interesting when you think about where the concerns in the market around private credit have been. And so the management also commenting about that, saying software as a service, yes, it is going to run into trouble, but Oracle is not going to be one of the places where it runs into trouble. They do database software, cloud software, accounting, and ERP software, and they're using AI to enable them to write software more quickly and to do it with fewer people, which is an interesting sort of tangent or sidebar story, I suppose, on the Oracle.
Well, tying into this, we had the TSMC sales yesterday, strong, and we've had the news of a blockbuster fundraising from Amazon, so raising $37 billion from a US dollar bond sale, and then you combine that with the planned euro bond sale, it could be nearly $50 billion. So interesting that you've got this very profitable tech company giving an alternative to treasuries in this volatile market environment because of the Middle East war.
Yes, and it was interesting to see the issuance story getting back into its stride in corporate credit, and we'll talk more about that a little bit later on in the programme. Let us tell you what is coming up on today's programme then. Janet Henry will be with us, HSBC Global Chief Economist. We've had some really interesting commentary from Christine Lagarde at the ECB about the comparisons with 2022 and how the ECB won't let that happen again. We will get Janet's perspective on that. Nanette Hechler-Weidurb joins us, Lombard ODA's EMEA CIO. How do you invest through this kind of geopolitical crisis? David Rosenberg will be with us, Oaktree Capital, head of liquid performing credit and co-portfolio manager. There's a public credit conversation, but are there risks coming from the private credit space that could affect, Lizzy, that sector?
Well, let's look ahead to what we're watching out for throughout the day. We have OPEC's monthly oil report before at 12:30 p.m. London time, US CPI. Then at 12:30 p.m. it's the Fed's Mickey Bowman speaking. Then at 3 p.m. London time, the ECB's Isabel Schnabel. And then at 6 p.m. we have the US federal budget balance. But really the highlight of the day has to be US CPI, expected to be more moderate at the core level in February. But of course this data predates the Middle East conflict.
Yeah. Is it the highlight? Yeah, given how it's backward looking. I mean, it's going to give us a sense leading up to this. But things have changed so much. The petrol pump prices are up. We know that the cost of food is going up. We know that inflation dynamics are increasing.
But there are underlying... So the view of Bloomberg Economics is, yes, absolutely, this is backward looking, and Iran changes everything, perhaps, at least for a period. But they say that even before Iran, there were signs of inflationary pressure building. And so they're saying increasing metals prices, memory chip prices, all of that was starting to filter through into the consumer space. And so that's something that will be interesting to see whether that underlying level? Because that does have some bearing on whether central bankers choose to look through or not inflation.
Exactly, which is the same commentary that we've heard from, I think it was Helen Jewell when she was on the programme, saying don't ignore the payrolls data on Friday. Likewise, CPI. Don't look through the macro story just yet and get too distracted by what's happening in the Middle East.
As concerns continue to emanate about risks around stagflation as well. Here's what else you need to know this morning. ECB President Christine Lagarde, meanwhile, says she will do whatever is necessary to ensure the war in Iran does not inflict the same inflation pain as Russia's invasion of Ukraine did. In an interview on French television, Lagarde said the euro area is in a better economic position and has greater capacity to absorb shocks. Meanwhile, it's been revealed that more of the world's biggest hedge funds suffered losses last week after the war against Iran triggered wild market moves. Bloomberg understands Rokos Capital Management lost 0.17%. Let's round that up to 0.2% last week, paring year-to-date gains to 2.3%. Coatue Management's hedge fund lost 3.8% last week and was down 2.4% this year. This, according to an investor letter seen by Bloomberg News. However, sources say Bobby Jain's hedge fund delivered a small gain of 0.1% last week. In the corporate space, Porsche says sales will remain under pressure this year as the luxury car maker grapples with tariffs and a costly course correction on electric vehicles. The 911 maker sees its operating margin reaching 5.5 to 7.5% this year. That is an improvement over last year's 1.1%. Still, full-year revenue will decline slightly.
Coming up on the programme, we'll continue the earnings focus. German defence company Rheinmetall says its 2026 sales outlook will come in softer than forecast. We'll watch that stock at the market open. Plus, we'll take a closer look at the credit space after the FT reports that JP Morgan story around restrictions in its lending to private credit funds after marking down the value of certain assets in that portfolio. But up next, we'll be talking to Aliki Rufiak, who is portfolio manager at Robeco, a multi-asset conversation about navigating geopolitics in 2026. If you want to get involved in these conversations, IB plus BBTV Go is the function to use on the Bloomberg Terminal. Live from London, this is Bloomberg.
The goal is to turn Iran from a nuclear and ballistic missile threat into just a regular country that stops threatening its neighbors. Both the United States and the Israeli Air Force have worked over the past 10 days to sort of clip off those capabilities. But we need to ensure that it's a permanent change and that Iran doesn't go back and nuclearize itself.
That was the former Israeli Prime Minister Naftali Bennett speaking to Bloomberg about military objectives in Iran. Now, President Donald Trump has warned Iran against laying mines in the Strait of Hormuz and threatened to blow up any ship attempting to do so. The U.S. Central Command says, quote, multiple Iranian naval vessels have been eliminated, including 16 mine layers near Hormuz. For more, Jumana Basechi, our Bloomberg's Horizons Middle East and Africa anchor, is in Dubai for us, of course, and joins us now. Jumana, talk us through the latest in the region.
Yeah, well, Anna, this is very clear that a maritime set of operations has also now begun throughout the course of the evening. And just to rewind a little bit, there were reports emerging yesterday suggesting that Iran had begun to mine the Strait of Hormuz with explosive devices. Now, later on, President Trump put up a post on Truth Social warning them not to go down that route, to remove any mines that might be in the Strait, and then also threaten them that the U.S. would retaliate and face consequences at a level never seen before if those mines had not been removed. Now, shortly afterwards, the Defense Secretary, Pete Hegseth, then also posted that the U.S. Central Command had started eliminating inactive mine-laying vessels, suggesting that they had targeted more than 16 vessels who have the ability to lay down those mines. So the big question here is whether Iran actually started laying the strait with mines, or whether they had indeed continued with those operations that began a couple of days ago. We don't know at this point, but what we do know is that they are still capable of bringing a lot of disruption to the Strait of Hormuz, and not necessarily from the mine-laying activity, but also from debris from intercepted missiles. This morning, the UK Navy saying that a fire broke out on one of their own cargo-carrying vessels due to intercepted debris. And then also there have been reports of the Iranians interfering with satellite, with GPS, with spoofing, i.e. giving fake signals and fake messaging to vessels looking to transit the Straits as well. So there are multiple ways that the Iranians have been looking to interfere or even harass any vessels looking to pass the Straits, which essentially means, as we've been talking about, that activity has basically been run down to zero, and no tankers, no vessels, very few of them are looking to pass through it because of those security and safety concerns. The US are trying to do something about it, but unclear at this point if they're going to succeed. And then even with the announcement that they're sending over some specialized experts to help remove explosive devices from the Straits, unclear how successful that operation will be, because the Iranians still preserve the ability to shoot at the experts who are looking to take out the mines. So it is another chapter that is opened up in this war. And I will say the operations have intensified once again. Pete Hegseth, the defense secretary, is saying that Tuesday was the largest day yet of operations, joint operations that US and Israel have inflicted on Iran since the war began.
OK, Bloomberg Horizons, Middle East and Africa anchor Jemana Pasechi with that update. Jemana, thank you. And of course, that reminds us that central banks and markets are readjusting to the inflation risks. If you don't get the Straits of Hormuz open, then inflation remains, of course, a concern. We had a red crab crossing the terminal a couple of minutes ago from the European Central Bank Governing Council member Peter Casimir, saying that rate hikes potentially could come closer than thought because of those inflation risks. And the ECB is still in a good place. There's no need to act at next week's meeting. For the time being, he says we need to stay calm, but it's possible, I'm paraphrasing at this point, it's possible that they move earlier than had thought in terms of hiking rates, given the inflation risks. Interesting on the back of what we've been hearing from the ECB's Christine Lagarde as well.
Well, we've seen another volatile 24 hours across markets as investors race to interpret rapidly shifting comments from the Trump administration over the Middle East war. Joining us now for more is Aliki Rufiak, portfolio manager over at Rebecca. Good to see you. So it seems like the president's, on the one hand, trying to calm the market, but on the other hand, talking tough when it comes to Tehran. Can we have faith in the end that it's the market that will restrain the president and mean this isn't a protracted war?
I think definitely. What we've seen already in the markets is a short-term relief rally that is basically driven by headline news. And for us, we do see that relative to our base case scenario when we started the year in 2026, where we were predicting a global growth upswing, and now the risks are clearly tilted to the downside. What we also see that the market is not really pricing yet is a differentiation between winners and losers within the more broader kind of space. What I mean by that is, for example, if we see the disruption in the Strait of Hormuz lasting more and oil prices remaining elevated, we should expect the market to start differentiating between countries that are net exporters of energy like the US and Norway, where we would potentially see their currencies being more resilient relative to countries like, for example, and regions, Europe and Korea, where these are likely to remain under pressure.
OK, so more geographical discernment the longer this goes on. But you have already cut equity risk. You've gone neutral. What signal would it take for you to get back in? Would it just be the president declaring victory? Surely not. Or would it be actually the Strait of Hormuz being opened?
I think the latter is kind of like a clear signal that would be very helpful for the markets, and definitely a de-escalation of the current Iranian war would be a very positive for risky assets. What we are also looking at the back of last week's price action, where mainly the market sell-off was driven by deleveraging, right? It was more a risk management exercise. So what we are looking more in the short term is equity volatility. So if equity volatility spikes, I would say that we would remain more cautious. However, we have today also inflation data, like moving a little bit more on the fundamental front, where US CPI, there again, if we see a print that is exceeding expectations, then this could be market negative vis-a-vis what's happening on the oil space.
Aliki, you mentioned in your notes that you're selling emerging markets and European equities as a result of what's happening here. I wonder, unpack the emerging markets theme for us a little bit, because I was reading a story this morning that talked about China emerging as an unlikely haven to the oil shock, despite its reliance, of course, on energy coming out of the Straits of Hormuz. The CSI 300, for example, has only been down a fraction of a percent as a result of all of this. So what does the sell emerging markets trade look like for you?
I think the sell emerging markets is basically more driven by our view on the dollar. Again, what we've seen last week is a counter trend rally on the dollar, and typically when historically we have seen very big geopolitical events, the dollar tends to strengthen over the next 3 to 6 months. There are also other more short-term drivers with regards to the dollar that could support this counter trend rally, particularly if we see oil prices going back up and if we see kind of like increasing tensions in the Middle East. And what I mean by that, positioning, first of all, and net flows in the dollar is favoring the currency at the moment. If the tensions are more long-lasting, the other thing that we might see is investors scrambling for liquidity. Okay. And dollar is the place to be, given that almost 90% of FX transactions are kind of related to the currency.
OK, so the dollar strength could continue then for a while.
Yeah, so that gets me to a question about what assumptions you're making around the Federal Reserve, where, interestingly, markets are still pricing in 30 to 40 basis points of cuts. A very different story for the ECB and for the BOE. So we're looking potentially at a divergent picture for central banks on the back of this conflict. How do you adjust the portfolio around that, and what assumptions are you making about the Fed?
Definitely, I think what is also good to note is the very sharp repricing that we've seen in central bank market expectations, both in Europe and the US. And vis-a-vis, again, what happened on Monday when oil reached almost 100. What we think in terms of where value could be sourced within the fixed income markets is probably more on the front end of the curves, where the price action has been more severe during this bear flattening exercise. Also, we would probably like more relative value trades that capitalize on recent market volatility and dislocations of interest rates on the long end of the curve.
Are you leaning into AI still, or not thinking too much about that trade at the moment?
I think AI is, again, something that at the back of last week's market action has come back to the fore, because the software space that has been particularly very weak since the beginning of the year has kind of was more supported. Our main concern there is funding, and as inflation, and if inflation remains elevated, goes back up, then I would see some volatility around the AI funding and the plans for capex that are rolled out by a lot of companies in the space.
Very briefly, are you worried about private credit?
We are, and we have been worried about private credit since the beginning of the year. So one of our I would say ways to hedge equity portfolio risk within multi-asset portfolios has been our underweight position on high-yield credit. And more recently, we've also seen signs of turmoil in the private credit space. Yeah. So we have also added in our hedges on the high-yield space.
Interesting.
As a result of that.
Thank you very much indeed. Aliki Rufiak, portfolio manager at Robeco. Coming up, as stagflation concerns continue to concern governments and shift central bank rate paths, we're going to speak with Janet Henry, HSBC's global chief economist, as the G7 says it supports in principle the use of strategic oil reserves. That is next. This is Bloomberg.
30 minutes from the start of the opening trade. Let's check in on the European futures picture this morning. We are pointing lower. Euro Stoxx 50 futures down 0.8%. Not so much weakness for the FTSE 100. We're down 0.3%. Again, once again, it is an energy story. We have oil up 0.7% on Brent to $88 a barrel. And there is a divergence between the European futures picture and the US futures picture this morning. Stateside, we're up about 0.2% for S&P E-minis, perhaps, Anna, because of the changing rate cut bets off the back of the latest ECB.
Yes, absolutely. And on the US futures, worth noting, they've come off their recent high, or earlier highs, haven't they, on some of that private credit news flow. But yes, absolutely. Let's go to the bond markets and look at that, because we are seeing some slightly higher yields this morning. We're up by 5, 6, 7 basis points on European bond yields. That's out at the 10-year horizon. And some of that, of course, going back to what we've heard from the ECB. Christine Lagarde trying to be reassuring, but the ECB's Casimir then saying that the rate hikes on Iran may be closer than thought, suggesting, Tom, of course, that this does add to concerns around inflation.
To your point, we've been hearing from ECB President Christine Lagarde saying that the bank will ensure the war in Iran does not inflict the same inflation pain on the euro area as Russia's invasion of Ukraine did. Lagarde saying on French TV, quote, "We will do all that is necessary to ensure inflation is under control." We are under control. We are joined now by Janet Henry, a global chief economist at HSBC. We've been hearing as well, Janet, good morning. We've been hearing as well from the hawkish member, the ECB, one of the hawkish members, Peter Casimir, saying that rate hikes could be coming sooner than expected. What assumptions are you making about whether or not the ECB, do they come through with an insurance cut given the scar tissue of Ukraine and inflation in 2022?
I don't think there was ever much prospect of an insurance cut. Obviously, there was a period when markets did think that the next move from the ECB...
I should have said insurance hike.
Oh, okay.
Insurance hike. Yeah. Insurance hike.
OK, but it's not so long ago that there were a lot in markets that thought that there would be slower growth, strong euro, that there could actually still be a cut. Now there's been a dramatic turn. We had always been of the view that the next move would be up for the ECB. But
this year?
I think the chances of a rate rise this year have risen. We've still got the rate rises in 2027. That's where we've always had them, because things could turn around at some point, particularly in the second half of the year. We just started the process of incorporating new oil price assumptions into our inflation projections, but then also thinking about the implications of higher oil prices for broader inflation. What does it impact on the rest of the economy? So I think we are going to get some kind of hump in inflation, maybe more from the Bank of England than for the ECB. But yeah, chances have risen this year, but at this point we've still got them in.
How much clarity do you have right now in terms of the stickiness of the inflation push from what's happening with oil, or whether or not, if the conflict comes to a relatively swift conclusion, that gets washed out? How sticky is it right now? Do we assume $75 a barrel on Brent going through this year on the back of what's already happened? How are you modelling oil price inflation shock?
Well, we're not modelling out at 75 through. Yeah, we've got 80 as the year average for the average for 2026. That's based on the number that came through from our oil analysts in the last couple of days. But it is based on an assumption that the next month is when you get the highest level of oil prices, and then it starts to feed through. But you've got different pictures all over the world. And we know in Europe, a lot of it is about gas prices. It's a bigger story regarding gas prices in Asia at the moment. We've seen what's happening with jet fuel prices and a broader array of prices. But a lot of the comparisons that people are making right now are with 2022 and the impact that we had on gas prices at that time. But then will the fiscal come in and cap the prices? And what is the underlying picture in the economy? Labour markets were strong then. People were getting higher pay gains. There was a chance of bigger second-round effects, and you have much higher inflation. So far, it's not as big on the gas prices side, but economies and labour markets are a bit weaker than they were at that time. So there's a lot of different moving parts that we are trying to model when thinking about the implications for inflation, and central bankers are all telling us, rightly so, they will do whatever it takes to meet their inflation mandates.
Help us understand what that means then, Janet, because putting up interest rates does not open the Straits of Hormuz.
No.
So what control can these central bankers have over the underlying driver of the near-term inflation risk?
Well, the most important thing is that they maintain their credibility and that they keep inflation expectations anchored. So they give reassuring noises and they wait to see what happens regarding the data. And that means, in particular, if you've got a much more inflation-driven mandate, that it's very much about the inflation numbers. Obviously, the ECB is already at target, pretty much, for inflation, even if core inflation is above the 2% level. But other than maintaining their credibility and managing inflation expectations, they can't do anything right now. But if it does not come out in line with their expectations and their forecasts because of different things that happen in the economy, then they will have to react to it in order to bring supply and demand and inflation expectations back in line with their mandate.
So would it be right to think of central banks as having to manage medium-term inflation expectations rather than managing what inflation does in the very short term? Is that the right way to think about it? Because we're sort of, I don't know, central bankers maybe are in danger of suggesting they can work miracles when it comes to keeping inflation under control.
Yeah, I think that's a good question because, you know, we always think about 2-year forecasts for inflation. That's what we always look at, what's going to happen over the next 2 years. But if you ask nearly all central bankers, they will say actually their mandate is to hit 2% or so at all times. But that is really what they are focused on. It is about the medium term. And I think this is the difficulty with oil prices if inflation expectations are not anchored. Now, they absolutely are in the case of the Eurozone, because if oil prices go up and gas prices go up and all these other costs go up, you're spending more on those goods. That should squeeze your spending on other areas, and other areas of demand and other prices should fall. And so you get what we call, in economics jargon, relative price moves coming through. But if inflation expectations are not anchored and you're spending more on energy and all these other areas and you succeed in getting the wage demands, then you actually get a higher level of inflation. But for the ECB, they just sit tight for now and make reassuring noises.
But of course, they've got a single mandate. The Fed's got a dual mandate. Is the energy shock necessarily hawkish for the Fed?
For the Fed, in some senses, because they are still, especially on PCE and core PCE, they are closer to the 3% level. We're here on CPI and PCE from the Fed this week, so they are higher on inflation. But, as you rightly say, they have got a dual mandate. And right now, they're not hitting either of them. But they're not so far away. You know, we're not at 10% inflation, we're at 3% on core PCE. We're not at 4.2% on unemployment, but we are at 4.4. So again, they can sit tight for now, and I think they roughly are at neutral until either unemployment picks up quite a lot more or inflation falls a lot more. Then, you know, obviously they can ease, they can look through current inflation because they're worried about the demand implications of higher unemployment. But if the labour market stays with unemployment around these levels and inflation goes a lot higher, absolutely it's hawkish, and that's why we don't think the Fed is going to cut rates further.
So when we get data like CPI today, because it's backward looking, do you not put much importance on it?
No, I don't put much importance, especially on CPI, because we've still got a lot of noise in it from the government shutdown last year. So we're really not going to know until April exactly where core CPI is. Core PCE, I might put a little bit more weight on it, but we've really only got is backward-looking data. It's all before the oil shock. Again, sit tight for now, make reassuring noises, but no need to rush into anything.
So, Janet, we're looking at the sovereign debt of Eurozone nations selling off again today. Gilts have sold off more aggressively, and we'll see what the print is when they start trading at 8 a.m. UK time. Is that the right view from investors around the sovereign debt of the UK? PIMCO remains constructive on gilts, but of course you have had many voices coming out say that the UK is more vulnerable to energy shocks. Where do you land on the story for the UK and how the BOE responds?
Well, again, I think the BOE has to wait a bit longer as well. We were never looking for a March cut, but the market was at one point, you know, strongly pricing that in. But we had looked for April. We've now postponed our prospect of a rate cut for the Bank of England to November. But when we do see a resumption of cuts, because we've got this another hump in UK inflation. But your question about how the markets look at the UK, I think it is partly that there's been this perception, and it's been borne out by the data, that the UK has a more persistent inflation problem. It's taken a lot longer in the UK, partly because some of the policies that have been delivered to bring inflation back towards target, and they get worried if this is going to be growth negative, lower growth, more damaging for the fiscal dynamics, adding to the risk premium.
You mentioned fiscal. Which country has fiscal space right now to deal with this?
Well, fiscal space, it depends on how you actually define it. Western governments, what they did coming out of COVID was very different to what they did coming out of the financial crisis, which was 1 year of massive fiscal stimulus, and then it was all about austerity. This year, it was about spending and spending and spending. So, no, there is very little tightening. The UK is not having a fiscal stimulus in 2026, but Europe is, the US is, and a lot of other economies are. The UK less so, France less so, but very few countries have got fiscal space to do more at this point, but that doesn't mean that we are not, if the oil price gets out of control, going to see some intervention in emerging markets in particular, but also potentially in advanced economies.
So we might need it, but we can't necessarily afford it. Janet, thank you very much. Janet Henry, HSBC Global Chief Economist. Good to see you. Well, investors are weighing the risks of the war as the Iran conflict continues.
What we've learned over time, and you saw this last year with Liberation Day, you saw this with COVID in the past, that you don't want to be too quick because these things can settle. And I think in this case, the war will settle. And then what comes back is the focus on the main thing. And of course, the main thing today is what's happening in AI.
That was John Gray, the Blackstone president, and we'll get more on how investors are weighing the ongoing war later. This is Bloomberg. 15 minutes away from the opening trade, we've got US futures just dipping into the red and Euro Stoxx 50 futures still down more than 1%. Of course, the focus remains on the Middle East, and the US military campaign in Iran is beginning to show signs of strain. That's the subject of today's Bloomberg Big Take, which says Iran has an arsenal of missiles and drones unlike anything the US has ever faced. Joining us now is Becca Vassar, defense lead at Bloomberg Economics. Becca, good morning. How sustainable is this pace for the US, given the rate at which high-end interceptors are being used, and how quickly can inventories be replenished?
So there's a number of different munitions that are being used at a fairly high pace by the United States, but also by U.S. regional partners. So you mentioned these air defense interceptors that the Gulf states have been using to combat some of the ballistic missile and drone threat. You also have some of the more advanced long-range weaponry that the United States has been using to strike various targets in Iran. Both of those are fairly limited, and they take a long time to produce. So the United States is trying to ramp up its production of some of these most critical munitions, but that's going to take a long time. They're trying to quadruple the pace, but that's not going to happen until 2030, and that is possibly going to leave a gap, not necessarily for the United States, but potentially for some of its regional partners and other allies around the globe.
Becca, when we're thinking about the economics of this and who has stockpiles of what and what they can afford to do, President Trump has warned Iran against laying mines in the Strait of Hormuz and threatened to blow up ships who are doing that. How does that add to our understanding of the economics of this?
I think you are right to raise the economic cost. Iran has low-cost ways of laying mines in the strait. They don't need highly specialized equipment. They've got small boats that they can use to emplace mines, and they can use those to further ensnarl commercial traffic and make it so that the Strait of Hormuz is off limits. If ships were to try and transit, that also is going to create an even greater potential cost should a mine go off. Additionally, for the United States, it's going to take time and effort to demine the strait. or also to conduct activities to go after some of those mine-laying vessels and potentially to escort ships through the strait as well.
Becca, thank you very much. Thanks for joining us. Becca Vassar, defence lead for Bloomberg Economics. Let's widen the focus and talk about the markets and how they respond to all of the latest news flow. Our Markets Live executive editor, Mark Cudmore, joining us now. Mark, I see from your notes that you are becoming increasingly bearish on stocks, just not sure which ones. And I share this level of confusion. I was reading a story this morning talking about China being an area of resilience, and we all know that a lot of the energy needs have to come from the Middle East. So what is your latest thinking, the latest questions you're asking about where the resilience and pain falls in stocks?
Yes, you're right, Anna. I am getting a lot more bearish. Up until really the last kind of 48 hours, I had been in the mindset, well, look, before this conflict, the macro backdrop for 2026 is so incredibly bullish. We have a massive amount of private sector spending. At the same time, we have a massive amount of government spending. We have easy monetary policy. We have growth. This is just the golden era for global stock markets is the backdrop for 2026. Then we got this conflict. And over the past week, I felt people have been complacent. I now just feel that I'm looking at it all wrong. It's actually which stock market has got to really slump first. It's not when do you buy the dip, because we're really not pricing the damage from this yet. We're getting a proper energy price shock. Even if you look far out, December futures are now trading about 17 or 18% above their one-year average. That's for December oil futures. The strait's not opening anytime soon. We've definitely got a supply shock coming through, and stock markets have been a little bit impervious. Now, I think China probably should be more resilient. They've been stockpiling for ages. They've got they're not vulnerable to an inflation shock. In fact, they've been struggling with deflation. It's not the right kind of inflation shock, but still they're better placed on the rate side. So China should be a relatively haven. But I do think other Asian stock markets might particularly suffer. Korea, Taiwan have done really well. India hasn't been a particular performer recently, but it's getting hit in the AI trade as well. So I think Asian stock markets should get hit further. I think European stock markets should get hit further. Generally, I'm just getting really bearish on stocks. And I think that at some point in March, we're going to have a real panic and a real washout when people realize, hey, the strait's still not opened. We're now day 10 of it not being opened, and there's no real sign.
So on that point, Mark, if this IEA oil release goes ahead, will it be taken as intended as a, release valve, or will it be another sign of panic to this market?
It doesn't matter if the strait doesn't get open. I thought it interesting that the last 3 times we've had a release from the IEA, oil traded higher a week later. To go to that point you just said, Lizzy, it's taken more as a panic rather than reassurance. So ultimately, we might get a little bit of a knee-jerk move lower, and that might be where the pain point is. But until the strait opens, we're going to continue to have drifting higher energy prices. And it's not just oil. This is what's really, really important compared to other crises. It's LNG, it's LPG, it's oil products, it's jet fuel. There's just a massive supply chain disruption in energy products on a quite sizable scale that we've not seen before. Basically, we need the strait to be sustainably opened for this to go away. And I just don't see how that's on the horizon anytime soon, given that we're understanding the scale of the drain capabilities of Iran.
Yep, European gas up 3.4% in the session today. Brent skirting $90 a barrel, up 2.2% so far in the session. Bloomberg Markets Live executive editor Mark Cudmore with the angst there, concerns about further losses across these equity markets on the continued closure of the Straits of Hormuz. Remember, you can get up-to-date analysis and insight from Mark and the rest of the team. Just go to MLive Go on your terminal. Let's bring in Jennifer Creary right now with the stocks to watch this Wednesday. Jennifer.
Good morning. It should be no surprise that energy is top of the news agenda again today. That's after the Wall Street Journal reported that the International Energy Agency is considering a record release of oil reserves to combat elevated prices following the outbreak of war in Iran. Now, that release would exceed the 182 million barrels that members put out in 2022 after Russia invaded Ukraine. Now, oil companies, you can see the shares have climbed steadily higher over the past year with some notable volatility since the start of the conflict, just under 2 weeks ago. So Shell, BP, Total, Equinor, those stocks in focus this morning. Next up, we're going to flip over to Porsche, the German luxury sports car maker, reporting full year results today, a dip in revenue, but also warning of weakening sales going forward. Now, Porsche has been struggling with a lot of the same problems as some of its rivals, including tariffs, but also struggling in its electric vehicles division, but also rising competition in China from local players. So those shares could be on the move this morning as well. Finally, we're going to end with Inditex, the Spanish clothing retailer, reporting fourth quarter results that were largely in line with analyst expectations. It also said that it's increasing its capital expenditure and increasing its dividend by 4%. The question is, will this be enough to shake off investor concerns that Inditex is losing steam? Of course, Inditex is reporting lackluster results as of late. We have an analyst quote saying that Inditex is one of the few consumer stocks that's offering investors a rare peace of mind at the moment. So let's see if investors agree this morning when shares open. Back to you.
Jennifer, thank you very much. Jennifer Creary with some of those stocks we will keep in focus. We are very much focused on Iran. We're also focused on the private credit story, of course. This has been something we've been following for many weeks now. And the latest news lines did seem to fall into a market that was a little bit nervous, looking for a bit of direction. And that private credit story from the FT around JP Morgan, it did weigh on sentiment a little bit. We saw a little bit of a tick down in futures as a result of that. And US futures are off earlier highs. They're pretty flat, just up 0.1% now on E-minis, but we factor in that as well as the after-hours Oracle news.
Yes, and of course we had Oracle shares moving then. Could we see European AI and software stocks taking the enthusiasm from the States when it comes to AI demand? So look at Nokia, Siemens Energy when it comes to AI and data center exposed stocks. Look at SAP and Sage when you're looking at software names as well.
There's just absolutely no sign that the demand for AI is letting up, and that those playing in the infrastructure space, yes, the costs are there, and yes, they have to sink that and eat that cost. But that demand, there's just no sign at all that demand for all of those capacities on top of data centers is going away. In terms of private credit, really interesting. JP Morgan's going to be lending less to private credit. That's the takeaway. Are other banks going to follow suit? And what are the second order effects of that for these private equity companies? They are going to be getting less access to liquidity at a time when they're already under strain.
And this plays into a theme that the market is already worried about, of course, and so it might get more attention as a result of that, given what BlackRock was doing and others that we mentioned at the top of the hour. Coming up on the programme then, we'll bring you the market open, 7:54 here in London. The futures picture does look negative for Europe, pretty flat for US futures. We will come back with the start of European trade. This is Bloomberg. Welcome back, everybody. A few minutes to go until the start of cash equity trading. Let's keep one eye on what happened in the States yesterday and what that means for the start of the European trading day this morning, if anything, here this Wednesday. This was the picture in the States. Europe closed out where this yellow line is, and so it does suggest that we have a little bit more downside to price in for European stocks, and that goes some way to explain some of the negativity around the futures picture this morning. We did see a lot of volatility in the oil price yesterday, and that was clearly being reflected in volatility in stocks yesterday, Tom. A lot of that coming through from mixed messaging from the White House, things tweeted and then deleted and the like. So there was a lot of volatility, as I say, in various assets at the end of the session over in the US. We will see what the futures picture means for Europe this morning. Yeah, there's concerns about what's happening in the private credit space. We've been discussing that. Oil prices are up again in the session, as are gas prices as well. And then we're getting hawkish commentary from members of the ECB and pricing in more hikes from the European Central Bank through this year. So that is weighing on futures after, as you say, a strong session yesterday. Gains of 1.8%, 1.9% today. A very different picture. Across the benchmark, you're looking at losses of a little over 1%. FTSE 100 looking to drop 61 points. And over in Germany, the DAX is called lower by 211 points, down 0.9%, Lizzy.
Well, Anna flagged that we'd seen oil dropping on that Wall Street Journal report that the IEA was proposing the biggest crude reserve release in its history. And so we are watching energy stocks once again this morning. We're also watching AI and software names after Oracle jumped in the aftermarket session yesterday. And we've got various earnings out today. Rheinmetall, Henkel, but I'll flag Inditex indicated higher on TradeGate after a robust gain in sales, Anna.
Yeah, absolutely. The Inditex story, something quite positive about the consumer from the beginning of March, in fact, which is interesting in the context of geopolitics and where that has an impact on the economy and where it doesn't. Contrast that with Porsche, where we've got a more negative earnings story or narrative to price in. Let's wait then for these European equity markets to get into their stride this morning. The FTSE 100 is out of the gates and it is negative, down by 0.3%. So catching down with the US of yesterday, perhaps. The Stock 600 as a whole then down by 0.3%. Of course, we've got the inflation data out a little bit later on today, and different views out there in the markets, the extent to which this matters in any other period where we're not ultra focused on one particular geopolitical story. This would have much more of an impact and a read across into the macro. Some people saying still watch it for that reason, and the underlying inflation dynamic pre-war still relevant. Others saying no, put that to one side. Focus instead very much on oil and what is happening in the Straits of Hormuz. With all that said, European equity markets then increasingly open and increasingly negative, down by 0.8% on the CAC 40. Still waiting, Tom, for the DAX to open up this morning.
Yeah, the best gains coming through for the retail space on that Inditex story. So retail is amongst two sectors in positive territory so far. Gains of 1.3% in that sector. Media also in positive territory, not by much, just by 0.2%. Every other sector in negative territory so far in the session. Industrial goods down 1%. Rheinmetall coming through with a view less optimistic than maybe some had thought. That could be a weight there. Basic resources, which had been one of the top performing sectors yesterday, currently down 0.9%. Tech, interesting on the optimism from Oracle, is actually under pressure. Tech as a sector is down 0.8%. That's a sector look. What are you seeing under the hood, Lizzy?
Well, you mentioned retail. Let's look at Inditex. The Zara owner, of course, off the back of those earnings, up 4.8% at the moment. Rheinmetall, though, on the opposite side, down 3.7%. Of course, they had slight misses when it came to operating margin for 2026 and sales as well. I'm also looking at Henkel, but waiting for them to open. But you flagged the AI data center story because of Oracle, and as you say, for most of that sector we're in the red, the likes of Nokia, Siemens Energy, Schneider Electric. We are seeing gains though for OV Group, and when it comes to software, gains for Sopra Steria Group, Net Company, but we're in the red for SAP, down 1.5%. I've also, we haven't mentioned this yet, got an eye on gaming because there was a surprise success for Nintendo's new Pokemon game, and you are seeing CI Games up 4.4% seemingly off the back of this. Ubisoft up more than 1%, as is Everplay as well.
Let's talk about the wider markets and what we're seeing here then. Lizzy, Nanette Heschler-Federb joins us, CIO for EMEA over at Lombard Odier, and joins us in person in the studio, which is great. Nanette, thank you very much for being with us. Given what's happening in the world right now, Nanette, what kind of risk appetite do you have when it comes to your portfolios and when you look across assets?
We're still moderately pro-risk. So, for example, slight overweight in equities via emerging market equities. The key for us is to still expect a conflict and a disruptor that is a matter of weeks, so not a protracted dysfunction of global oil markets, and that has kept us with a steady hand on the strategy.
That's interesting that you talk about emerging markets. I mean, that's a trade that was very popular before the start of the Iran war, very much linked to the dollar, I think, in the case of many people. Does that mean then if we are able to ring fence the war, if it isn't protracted, do we go back to some of those themes that were doing pretty well at the start of the year around emerging markets and around a weaker dollar?
Yeah, I think there are some very strong structural stories. I mean, China is the most important market in the emerging market index. And so the resilience that China has shown in the face of this shock that we are experiencing right now has been very positive. And then the structural stories there, for example, being exposed to commodities, a number of indices, take, for example, South Africa, take Brazil. All these indices in equities have a large share of commodities. They've been doing well. And also there is a structural story in terms of the earnings. This is the first time that we are having expectations on emerging market earnings that are higher than developed markets.
Nanette, it's the China story. Are you buying China on a tactical basis or on a strategic basis?
No, it's really, these are markets that have volatilities such that we prefer to do it tactically. We are neutral China in the overall complex. We do have a positive view for that market, but we also think that South Asian names such as India, such as South Korea, will probably also show some interesting entry points here.
Where do you think we are in re-rating European equities?
European equities, they have derated quite a lot in this time, and that's very understandable because they're so exposed to the actual oil source coming from the Middle East. So for European equities, I would really say it all boils down to how long this source of energy for them is disrupted. I'm not sounding the all clear yet here.
What gives you so much faith that this is going to be a short war? Is it that you have a faith that the president will chicken out? And if so, we had a guest sat where you were yesterday saying that the limits for what Trump will tolerate were very clear in his mind, that, you know, it would be $120 a barrel on oil, maybe $100 a barrel, a certain rise in yield and 30 to 40 casualties when it comes to US service people. Do you have a framework like that?
Well, we just look at all the parties involved in this war and can only come to the conclusion that all of them have an interest, a shared interest to make this a short affair. Take Iran to start with. They are in an economic position that actually tells us it's their interest to unlock some of the economic challenges that they're facing right now, on top of everything else. Take the United States. Everything you mentioned is certainly right from an economic standpoint, but there is also the domestic political setup. I mean, Donald Trump is going with the Republicans, is going into midterm elections. And so I do think that we should also keep in mind this domestic political setup for the U.S. And then finally, for the rest of the world, everybody has such an interest that we can come to a place where the Hormuz Strait is secure again. Right now, it doesn't even take much action by the Iranians. It's just the insecurity, the general sense of risk associated to commerce through that strait that is blocking everything.
OK, so surely it's got to be a short war. But Nanette, I'm also interested in your view on havens, because you're overweight gold when it hasn't necessarily been the best performing haven, and you see the dollar strength as temporary. Why?
Yeah, so the dollar is in general rallying when there is oil price going up. And this is for the reason that the U.S. is one of the biggest oil producers. So in general, their terms of trade are improving when oil prices go up, and the dollar is benefiting from that. But if we are of the view this is all protracted, and the oil price should over time come back into maybe vicinities around $70 per barrel of Brent, then actually this support, short-term support, goes away from the dollar. And on top of that, the Federal Reserve should be lowering interest rates later into the year. That's also negative, the dollar.
Does that mean you think bonds have sold off too much?
Well, bonds have been volatile, and to be honest with you, for the U.S. 10-year Treasury yield, we are seeing 4.10 as a good level for the whole of 2026. This is going to be up and down from here. We don't see a very big trend, so that's not the market that we are most interested. Turning to the gilt market, that's the one where we feel that there is interest in the yield when we contrast that with what, for example, domestic investors are getting.
You want to buy gilts at this point?
We would.
At the front end, where in the curve?
No, we are in general having 5-year preferences in terms of the maturities that we look for. But in general, the 10-year at 4.55 is an attractive yield.
Nanette, you were talking about European stocks, and you were thinking about the vulnerabilities of the European economy. You mentioned earlier, obviously vulnerable to the higher energy prices. We heard from Christine Lagarde overnight that she thinks that the European economy, obviously she's talking about the Eurozone here, is more resilient than in 2022. Do you see signs of that? She talks about inflation, energy, the economy itself all being more under control than they were in 2022. Does that give us any reassurance?
I'm really not so sure. I think that Europe is still very exposed in terms of their energy sources. And then when you take a look at the gas reserves in Europe, we are starting from a point where, there's not too much to draw from. So I do think that there is some optimism. We have at the moment just lowered a little bit our growth forecasts for Europe for this year and raised raised a little bit, 0.2%, our inflation forecast. So for now, we are okay with the comments by Christine Lagarde, but it all really depends on the situation in the Middle East. This could change quite rapidly.
Nanette, good to see you. Thanks for coming in to see us. Nanette Heckler-Feiderb, CIO EMEA over at Lombard Odier. Well, let's check in on the core six. We've, of course, already mentioned Rheinmetall out with earnings this morning. Softer than expected, and we're down 5.2% on that stock. That's the standout. We're red across most of the core six this morning, but Novo Nordisk managing to eke out gains of 0.9%. Schneider Electric there down despite the positive story told by Oracle overnight. But let's get a check on some of the individual stocks we're watching with Jennifer Creary. Jennifer.
Good morning. Let's start with one of the winners of today's session, and that is Inditex, up 3.9%. That's after Inditex, the Spanish parent of Zara, reported fourth quarter results that were in line with analyst expectations. It also said that it's increasing its capital expenditure and increasing its dividend by 4%. Investors are clearly happy with that after a series of fairly lackluster results from the company and also weaker consumer sentiment. Next up, we're going to flip over to Rheinmetall, the defense and autos company, down about 5%. That's after the company predicted that sales would fall short of expectations. It's at a particularly critical time for the German defense contractor, at a time of increased European military spend, where the company really should be benefiting from that. So those shares down on the open as well. Next up, we're going to flip over to Gerresheimer. That's a maker of packaging for medicines and cosmetics. The company delaying again its audited annual and consolidated financial statements for 2025, saying that it's taking longer than expected, and that delay could potentially result in the company's exclusion from Germany's small cap SDAX index. Those shares really getting hammered on the open, down 10%. Next up, we're going to flip over to energy. Energy really kind of flat on the open, and that's after the Wall Street Energy Agency is proposing a record release of oil reserves to combat elevated prices following the outbreak of war in Iran. Those shares wavering on the open.
Jennifer Creary, thank you very much indeed. I'm also looking at Balfour Beatty, stock up about 8%, despite the fact that the earnings actually came through with a miss. But there's a share buyback from the UK house builder. At one point, this is you got to a record level. I think we're at records in terms of Balfour Beatty. At one point, the stock was up 13%. It's now up about 7.8%. So the house builders and Balfour Beatty coming through with a share buyback to repurchase £200 million of shares during 2026. A really strong move there.
And away from this more of the infrastructure story, isn't it? So the international engineering and construction rather than specifically house building. But interesting that we get such a pop in the shares this morning.
Yeah, and in Germany, chemicals maker Henkel down 5% more than earlier in the session, currently down 3.5%. But this was after a miss on its organic sales, likely impacted by that weak consumer sentiment that you were referencing earlier, Anna, particularly in Germany and the US, and also tougher competition, Tom.
OK, coming up, more on those Rheinmetall earnings. The stock is currently down 4% after the defence firm said 2026 sales will fall short of analysts' expectations. We're going to unpack those numbers next. Stay with us. This is Bloomberg.
Welcome back, everybody. This is the opening trade. We're 17 minutes into a European equity session that is broadly negative for European stocks. You can see the Xetra DAX is down more than the rest, and we'll come to Germany in just a moment. The DAX down by 1.1%. The FTSE 100 down 0.6%. The IBEX getting a bit of a boost from what we're seeing at Inditex, and that is lifting the retail space. So in amongst the gloom that we're seeing across European stocks today, there is that positivity coming through, Lizzy, in the shape of the Zara owner Inditex. Real resilience being shown in the strong sales gains, despite their exposure actually to the Middle East story. They do seem to be giving some decent guidance for the early part of March.
Yeah, as you say, part of what's weighing down the DAX this morning is Rheinmetall. Those earnings out this morning, and the shares down 3.8%. This after it posted a 2026 sales outlook of 14 to 14.5 billion euros, so falling short of analyst expectations at a critical time for the company as Europe's military spending plans take shape. Let's get more now from Oliver Crook, Bloomberg's chief Europe correspondent. Ollie, you'd think that these uncertain geopolitical times would benefit Rheinmetall. What do you make of these earnings?
Yeah, absolutely. It seems that the market is more focused on the sales forecast for 2026 and what we got out of 2025. So I'll go through quickly what we got out of 25 and then push us forward to 26. So the operating margin for last year came in at 18.5%. That's actually a beat from what the market was anticipating at 18%. Their full year dividend per share as well was something that came in well above the estimates. It came in at 11.5 euros. The expectation was for 10.33. And that being said, Lizzy, I mean, listen, they closed out the year with a backlog of 64 billion euros in terms of order books sitting on their books that they're still waiting to make. That is a massive beat from what we got the year before of 47 billion. That being said, there's a little bit of sort of less excitement in the market. You can see today down about 3.5% on Rheinmetall, and that is down to the sales forecast. The sales forecast coming in at 14 to 14.5, which is shy of the just about 15 that had been anticipated. That being said, we are still talking about sales increases next year of 40 to 45%. We should also say that in their earnings release, there was no explicit mention of Iran. We can expect that that will be a tailwind for this company whenever there is war and uncertainty. That is something that generally helps out Rheinmetall. And we should say that despite the fact that we see the shares down about 4% this morning, that brings their year-to-date performance down to basically zero. That being said, since 2022, the beginning of the war in the Ukraine, this is a company whose stock is up 1,700%. So that's really the broader context for this company.
Yeah, important context there. Elsewhere in the German earnings story then, Ollie, we had numbers from Porsche. We seem to miss estimates. What's the latest?
Yeah, so this is the sort of the tale of two industrial companies within Germany, where Rheinmetall and defense really getting a boost and really seeing the sort of diminishing ever of the auto industry. And we should say that going through kind of the main issues for Porsche, they had to take a massive write-down on a number of different issues, partially tariff-related, partially dealing with their EVs in a pivot away. That was almost 4 billion euros, so that has really weighed on the margins. But looking at this, they actually did put a cost of what U.S. tariffs cost them last year, 700 million euros. If you look at the sales in China, this has been a massive struggle both for Volkswagen, the parent company, as well as Porsche. For Porsche, their sales in China down 26%. That has brought their margins for last year down to 1.1%. That is very, very, very low for any car maker, particularly for a very luxury sports car maker like Porsche, and that is down. So 1.1%. The year before, it was 14%. So that just gives you an idea of the difficulties that is being faced here in the German auto sector. Their margin forecast for the coming year is about between 5.5% to 7.5%. But again, 5.5% is the kind of margin you'd hope to get on a volume vehicle rather than a super luxury sports car. All of that being said, the focus for Porsche, for Volkswagen, this is part of the theme that we discussed with them yesterday, is all about cost cuts. It could mean more job cuts at Porsche. And looking for the sort of bottom for the German auto sector, I'll just quote from their earnings release in terms of what they're anticipating this year, anticipating a very challenging market conditions for 2026. In China, the luxury segment remains under pressure. Porsche expects geopolitical uncertainties and U.S. tariff policy to remain in place, and the potential impact of recent developments in the Middle East have not been taken into account. So really a vast panoply of risks for this German automaker and German auto industry under considerable fire for the last few years.
So, Ollie, we're talking 18% margins or so for Rheinmetall, 5.5% margins for Porsche. Talk us about the links between the auto industry in Germany and the defence space, which you have reported on, and now VW, it seems, making moves as well.
So this is super interesting, Tom. This is a conversation I've been having with a number of sort of defense companies, and they're talking about basically getting partnerships with some of these automakers and some of the auto suppliers, because this is the predicament that you have here in Germany. You have an auto industry that has a massive amount of expertise, massive amount of capacity, but the orders are just not there. And then the defense space, you have effectively the exact opposite. You have their order books overflowing. They do not have the capacity. They do not have the scale to produce what they need to. So increasingly, as the years go on, you're going to see, I think, more and more partnerships between the defense sector and also within the auto industry, so in parts. But what we also understand, and this is something I asked this CFO of Volkswagen yesterday, he did not confirm this, but he sort of gave me, it seemed to me, an indication that this was in fact the case, that one of their factories, their Porsche factories in Germany, they actually have been building military prototypes that they've been showing at trade shows, defense trade shows. And I asked him about basically what role Volkswagen could play in the German defense defense build-out. And this is something that the CEO, Oliver Blume, has talked about, and it is something that they're talking about doing right now. They have not yet been able to sort of quantify how much of this business that could be going forward. But again, and what we're looking at, as you can see on the screen there, Volkswagen down almost 17% over the last year. The defense industry is where so much money is flowing, so this could be a real opportunity for some of these automakers.
Ollie, thank you very much indeed. Our chief Europe correspondent, Oliver Crook, on some of the earnings story and interlinkages now between defence and autos. We have an update and a redhead that crossed the terminal a couple of minutes ago. This is from Amazon, kicking off a debut 8-part euro bond sale. This, of course, after they went to the markets in the US yesterday and raised $37 billion in terms of dollar bonds. It was oversubscribed, a lot of demand for that, so we'll see what the demand picture looks like. But they are looking potentially to raise up to $50 billion US dollars. Let's bring in Matt Bloxham then from Bloomberg Intelligence on the back of this. Matt, what do you read into the fundraising coming through from Amazon and the kind of ambition it signals for this company?
Yeah, I mean, I think partly it's that actually big companies like Amazon are a better proxy for low risk than taking government treasuries, for example, and this is a kind of reassuring sign for them that investors still believe in their long-term future. I mean, I think in the context of $50 billion sounds like a lot of money. They don't actually really need that money. They've got about $66 billion of debt right now, but over $100 billion of cash on the balance sheet. And obviously what they're doing is kind of essentially kind of freshening up their balance sheet, if you like, in anticipation of the $200 billion or so they're expected to spend this year on capital expenditure, primarily to support their AI plans. But even that's more or less covered by the cash flow they generate on an annual basis. So this is a company in pretty rude financial health. I think obviously the big question for them, along with the likes of other companies like Oracle, for example, is how long is the AI demand cycle going to last, and will this $200 billion be money well spent when we look back in 2 or 3 years' time?
Yes, let's talk about that CapEx. And Oracle is doing some CapEx of its own, isn't it? The numbers going down pretty well with investors, certainly after hours. This is a stock that's had a lot of scrutiny on it because it seems to be playing two roles. On the one hand, there are software concerns, competition from AI on the software space, but on the other hand, they're part of the infrastructure build-out.
That's right.
What's the latest?
Yeah, I mean, it's been caught up in every single way you can imagine in terms of the hype around AI, but also the kind of pressures. And obviously, one of the most recent things is the SAPocalypse, if I've said that correctly.
SAPocalypse, yeah.
And that maybe their software business is going to be exposed. Now, actually, yesterday they came out with very strong kind of reassurance that that they don't see themselves exposed to that. They're actually using AI to reduce the number of people they need to develop code quicker and more effectively. I think the number people really looked at, though, was the $50 billion of CapEx they're planning this year, and the fact that it didn't go up. So you had better revenue numbers than expected, an increased forward guidance, about $80 billion now of revenue, also $90 billion. But yeah, no increase in CapEx. Now, some of that I think is because they're carefully managing it. Some of it is because they're actually asking customers to bring their own technology with them. So they're saying, here's the space, bring your own NVIDIA chip. So they're essentially shifting some of that spend they might have incurred to some of their customers.
That's a really interesting dynamic, Matt. Thank you very much. Matt Bloxham joining us there from Bloomberg Intelligence. We are going to come back and talk about the impact this software story is having on private markets. In fact, JP Morgan restricting private credit lending after loan markdowns. We'll have more on that story. And really, it goes back to what Matt was just talking about there around software and the extent to which private credit has been lending to software companies.
Really interesting comments from a senior member of PIMCO in a podcast talking about the sloppy underwriting of some of these deals in the private credit space. And of course, as you say, at a time when JP Morgan is writing down at least the value of some of the private credit companies' loans, which means they're going to be lending less.
So we'll talk about private credit. We'll also talk about the listed credit space, the public credit markets. Is there any kind of contagion between the two? More on that conversation coming up shortly on this programme. 8:26 here in London. This is Bloomberg.
This is the opening trade. We're 30 minutes into today's session, and as you can see, it is red across the screen for European stocks this morning. Particular weakness for the DAX in Frankfurt. We had disappointing earnings from Rheinmetall earlier. More on that in just a moment. But there's only one sector in positive territory this morning, and that is retail. We had more positive story told by Inditex out of Spain. US futures fluctuating. Tom, what are you seeing at a more granular level?
Yeah, we're going to hope to show you some of the individual stories. It's interesting. We've been hearing from Inditex and their exposure to the Middle East. No significant numbers of stores closed there, according to that company. But it's more broadly about the demand that they're seeing in the sales numbers that's lifted that retail space, as you say. Just one small area of optimism in the session today, because broadly, after gains of 1.9% for European stocks across the benchmark yesterday, a very different picture today. So 490 members of the Stock 600 currently in negative territory, just 98 posting gains. Volumes a little bit lighter than they have been, just down 6% or 7% or so. So a little bit softer in terms of volumes. There's a big spike in volumes yesterday. Different picture today. In terms of the leaders then, let's give you some details on the Inditex story. As I mentioned, it's about results and that relative resilience. And so you're seeing Inditex up 2.3%. 2.7%, almost 3%. In terms of what's happening on Novo, this is rated new outperform, the drug maker this morning. That's at Santander, so that's getting a bit of a lift, just 0.6%. And Ellis popping 4% as well. EBIT is coming in terms of matching the average estimate. And so it's getting a bit of lift in terms of meeting those expectations. On the downside, we've been breaking down the story for you around Rheinmetall. This is not about a story of a company performing badly. 2025 was very strong. It's just missed expectations for 2026, essentially, as that fiscal spend comes through from Germany in the defence space. Currently down 4.5%, but that's in the context of this significant rally, of course, over the last 2 years for Rheinmetall. ASML, of course, in the tech space with those lithography machines, currently down 0.9% after 2 sessions of gain, so maybe a little bit of profit taking there. Back to the drug space, and this is Roche dropping close to 2% after the late-stage trial setback for its experimental breast cancer pill. So Roche under a little bit of pressure in the session today. Anna.
Tom, let's get an update on some of the other stories we are following this morning. The International Energy Agency, the IEA, has reportedly proposed the largest ever release of oil reserves. According to the Wall Street Journal, the proposed release would exceed the 182 million barrels released in 2022 after Russia invaded Ukraine. It comes in response to cuts from Persian Gulf producers that have shaved about 6% off global oil output, sending prices of jet fuel and cooking gas soaring. Over in monetary policy, the ECB Governing Council member Peter Casimir says the Iran war and its impact on inflation may force the central bank to raise interest rates sooner than anticipated. Casimir adding that the balance of risks regarding inflation has clearly shifted to the upside, and businesses may pass through higher costs to consumers more quickly than in the past. And Bloomberg has learned that JP Morgan is restricting some lending to private credit funds after marking down the value of certain loans in their portfolios. The devalued loans are to software companies, a sector that's been in the spotlight in recent weeks due to investor concern over the potential impact of artificial intelligence. Tom.
Let's get more on that story and other movements within the private credit space and bring in Bloomberg's EMEA Credit Managing Editor, Dana Albatji, on the details. Dana, thank you for joining us. There's been a bit of news flow, a fair bit of news flow just in the last 24 hours in terms of what's happening in private credit. But standing out from that is the Financial Times story around JP Morgan marking down some of these loans. What are JP Morgan seeing? Why are they making this move?
So obviously the valuation of those loans have been in question because we've seen some big moves within the stock space, and there's been a lot of concern over the future of the software business, specifically because of the developments that we've seen in AI. So JP Morgan has basically done what you would expect people to do, which is to revalue these loans in light of these moves within public markets. And of course, that extra step to basically say or to limit the sort of lending that they had done in the past to private credit firms is also in line with what we're seeing across the private credit space, to be honest.
And PIMCO is blaming sloppy underwriting. Is that fair? They say there's a reckoning going on.
I think that, when there's a lot of excitement within a specific industry, you do have a tendency for some of the lenders or the direct lenders to be a bit more gung-ho. Every industry goes through this. It's basically the maturation process of any industry. And so it's not a surprise to see this sort of thing here, but also a reckoning is not necessarily a bad thing. Usually after a reckoning, you get more regulation, you get more rules, you get more prudence. So this might actually just be part of the process of the industry's growth.
Yeah, going to elsewhere in the private credit space, we have Cliffwater, another private credit provider, facing redemptions of more than 7%, Dana, at one of their flagship funds. I mean, does this go back to, we're still trying to work our way through what the retail investor presence within the private credit space means for redemptions, for any gating or any caps on the amount of redemptions? Are we getting a firmer understanding of what it is that private credit companies will and won't do at this point?
Absolutely. I think gating is a mechanism that is there in order to allow retail investors to participate in a space that is very illiquid. So this is there to protect the private credit lenders, but also the retail investors. Yes, you will always see panic at certain points in time. However, gating is there for a reason. The reason why this always seems to be causing panic over the last 2 or 3 weeks is because we don't get much information about the value of these loans. We get it every 3 months or so on. So when they do come up and we see these sort of things, people do panic.
Okay, Dana, thank you very much. Thank you for joining us. Bloomberg's EMEA Credit Managing Editor, Dana Al-Bashi. Great to get your perspective on this story. Let's get another perspective on this story and how it influences other parts of the credit space. David Rosenberg joins us, Head of Liquid Performing Credit and Co-Portfolio Manager at Oaktree Capital. Really nice to have you with us. Thank you very much for joining us, David. You operate very much in the public credit markets, don't you? But there do seem to be a lot of people asking questions right now about where there are going to be links between the two, whether what we were just talking about there in private credit is going to be systemic, and if that's going to affect public markets via public credit. What was your perspective on that?
Yeah, I haven't seen it yet. I mean, we have a lot of conversations about this with people want to sell, and liquid credit you can't sell. And so people turn and they sell what they can is kind of the expectation. However, if you look at why people are scared, a lot of it drives lately to software and things that you don't see a lot of. On the public side, a lot of that's gone to the private side. It's been a different source of financing. And so we haven't seen that contagion spread just yet. Quite frankly, people show up to buy the dip more often than not these days.
Right, so that's interesting. Do you think public credit markets then, public corporate credit, is going to be protected by its sectoral makeup, by the fact that a lot of the faster growth software stuff went to the private space?
Yeah, I think it'll be buffered. If you think about the spectrum, you take the high yield market, for example, software is maybe 4 to 5%. You take the syndicated loan market, it's maybe 10 to 15%. It's when you get to the BDC market where it's 20 to 30%. And as you get bigger, your concentration to LBOs, which is really the riskier stuff, gets greater as well. And so I think there's a different risk for different markets.
Let's factor in the geopolitical risk. You've got oil swinging wildly on single headlines. With that backdrop, how resilient is sub-investment grade credit really?
Well, so it's a really good question. Right now, if you look at the quality of sub-investment grade, it's really, take the high yield market, for example, it's the best quality we've seen in over 10 years. And the reason is COVID. COVID happened, you had all these investment grade companies get pushed down into high yield. All the really weak companies defaulted. So we had this cleansing of the market. Usually the recession is the cleansing event. We had a cleansing event before a potential recession with COVID. And as a result, right now, I think that's the biggest reason people show up to buy the dips so programmatically, is that the overall quality, there's tails to every market, but the overall quality is actually quite good.
So you've said you're in protect the coupon mode right now. What does that mean in practice? What are you refusing to buy?
Well, it's just, so take what's going on in the world, and I find this so fascinating to me, is we're not even 3 months into the year, not even 3 months, and already we're going to invade Greenland, not invade Greenland, we're going to fire Powell, not fire Powell, bomb Iran for the second time, had the SaaS apocalypse, oil went above $100 a barrel, and yet markets just keep grinding higher. People seem to have this resilience to ignoring news that's frankly scary. And so in that market, where the market doesn't feel like it's pricing in a lot of risk, we'll generally lean towards quality because the coupon's already very high. I don't need to be a hero to get a good coupon today. I just want to earn it. And I feel like there's going to be better times before this year's over where you're going to want to lean into more interesting things.
That's really interesting. So, and you talked about the clearing out event that happened during COVID and the fact that that's left resilience. So to be clear, that list of shocks that you just outlined for us and the current conflict in the Middle East, that does not trigger another clearing out event.
I don't think yet. I mean, when you take the Middle East, look at the shape of the future curve for oil, most people are expecting this to be a short-lived event. And we'll see. There's logic to it. It makes sense that it would be short-lived, but it doesn't mean it will be. And so I think if it's not short-lived and we start having to live in a world with higher oil prices for longer, that's going to ripple through a lot of different sectors and you'll see a repricing. But right now, that doesn't seem to be the base case.
And I want to look back to your first answer in terms of the linkages between private credit and the public space.
Right.
Do you see... So do you see flows out of private credit into the public space, or do you see a sell-off and re-rating of public to fund any losses in the private space? What are the flow dynamics right now?
Yeah, haven't seen a lot of back and forth, right?
No.
So difficult to sell private credit, so they get to lock up their capital, so not a lot of money coming out necessarily. I think what we have seen so far is whenever there is a period of weakness, money shows up very quickly to buy. Very frustrating for people like me. I'm looking for a little more volatility, but right now we find that even on days when we announce the war in Iran, the market will get marked lower, but nobody wants to sell to you lower, so it's very difficult to move because everyone's waiting for it to be back up the next day, which it was.
David, how structurally, and you've already talked about the different sectoral makeup of public credit markets versus private, but structurally, does this public market look like the one that went through COVID or the one that went through the GFC? And the reason I'm asking this is people talk about a lot of the riskier stuff having gone to the private space.
True.
And so is it structurally just set up to be more resilient than it was? I wonder how much history helps.
Yes, it is better. It's a better quality market, right? So you can use ratings. People like to use ratings. It's a blunt tool, but it's a good one. But the high yield market is the highest percentage double B we've seen in a decade, lowest percentage triple C we've seen in a decade, over half the market double B rated. That we haven't seen that. And so when things go wrong, if you go to quality, over half the market's very good quality, so it's very easy to step in and buy. I think that also drives this kind of dynamic.
So you're adding to European loans and real estate debt,
Yes.
I think. Is that because they're genuinely better relative value, or are they mispriced because of the energy risk?
No, I think it's the former, and so you take them both separately, right? Real estate debt I find very interesting because you go into the residential market in the U.S. and the average mortgage is roughly 3, and a new mortgage is roughly 6. Right, so if I sell my home today, I can only afford to buy back half of it tomorrow because real estate, generally the one asset you borrow the most to buy, and so there's no supply. And that lack of supply has been propping up prices in a way that you have this loan to value is very strong. And so when you have periods like Liberation Day and you have periods like when we went in to invade Venezuela or bomb Iran, residential real estate prices are very stable. So it's a great diversifier. You can earn around 7% in a double B RMBS security without having to take a lot of volatility. Now, European loans, frankly, is cheaper. And so what we found for a while, a lot of people talking about U.S. versus Europe, and the view was, I'm worried about the loss of U.S. exceptionalism, and I'm worried about a recession in the U.S., I'm going to go to Europe. I don't think you can hide geographically from a U.S. recession. I don't think that works. It's too global of a market. But we did find European loans in particular were cheaper. Frankly, there's less CLO creation. There's no loan ETFs, so less competition, better pricing. And so we found that you can get like-for-like risk. You can get almost 100 basis points extra yield to go to Europe. So that's been very attractive. We found that other people are cluing into that too, so that pickup is starting to shrink, and so we're starting to kind of look around for other things.
What opportunities open up, or risks, in an environment where we have rates higher for longer from the ECB, from the Fed?
Well, higher for longer, I think, really goes back to, if you think about all the LBOs, not just software, but LBOs in general that got done pre-COVID when money was free. And when money was free, it turns out you can pay a lot for things when you get to use free money to finance it. And so a lot of these companies are very levered, and some of them, balance sheets won't work if rates don't go back down. And that creates opportunities within the debt market because you can choose where in the capital structure you want to position yourself. And so there's some interesting things, I think, that could come of this. You also have my favorite thing, and you'll probably see more of this, frankly, in the private markets than the public, but rescue financing becomes a very attractive opportunity if rates stay higher for longer. Whenever companies are desperate for money, they tend to pay very attractive yields for it.
Do you see a higher for longer rates environment then, David? Is that what you're preparing for?
I do, and I think the dynamic is it's all the devil in the details. I think the path of rates is down. I do think rates should go down. I just think it's a smooth glide path down, not a step function drop. And the market keeps finding ways to convince itself we're going to get a step function drop, frankly, because they want it, because it's good for risk assets, but that doesn't mean it's going to happen. And I think in this environment in particular, where you're now seeing the potential inflationary impact of higher oil, that it's going to be a much smoother glide path.
David, really fascinating. Thank you very much indeed on the public credit markets and the linkages between private and public. David Rosenberg, Oak Tree Capital co-portfolio manager and head of liquid performing credit. Coming up, we're going to get the latest from the Middle East as the IEA reportedly proposes releasing the largest ever stockpile of crude. That takes us, of course, back to the inflation story and the rate story. More on that and Trump's latest threats as the war in Iran enters its 12th day. That is next. This is Bloomberg. Welcome back to the opening trade. We are 48 minutes into today's session. European stocks across the benchmark down 0.9%. Just one sector in positive territory, that is retail, up 0.6%. Anna.
President Donald Trump has warned Iran against laying mines in the Straits of Hormuz and threatened to blow up any ships attempting to do so. The US Central Command says, quote, multiple Iranian naval vessels have now been eliminated, including 16 mine layers near Hormuz. Joanna Basecchi is Bloomberg's Horizons Middle East and Africa anchor and joins us now from Dubai. Joanna, talk us through the latest developments then.
Yeah, well, a very different set of circumstances from where we were 24 hours ago when President Trump suggested that the end of the war was coming. If anything, operations have intensified. The U.S. Defense Secretary saying that actually the operations that took place yesterday between the joint U.S.-Israeli operations were the heaviest day of airstrikes that they have inflicted since the beginning of the war. So that is still very much going on in the background. But increasingly, we're seeing an opening up of a new front, a maritime front. The U.S. Central Command releasing footage overnight of them taking down more than 8 dozen of these Iranian vessels, which were seen to be holding mines that could go off, explosive devices. President Trump also taking to Truth Social overnight as well and warning Iran about not placing any of those mines on the Strait and warning them that there could be extreme consequences if they do. And so this is a new front that has opened up. I will say, though, that irrespective of whether Iran has actually placed these mines or these explosive devices in the Strait, we're still seeing very few vessels wanting to cross through it. And actually this morning just underscores the risk of vessels going through. 3 vessels reportedly caught fire because of intercepted debris. Unharmed board members, but at the same time, it just shows you that there are still very elevated risks and concerns about passing through the Strait, even though it's very much on the U.S.'s radar now to try somehow to ease up the passage of these vessels going through, but no real fundamental change on the ground. And at the same time, Iran continues to fight back. Sirens going off in Bahrain, over here in the UAE, more projectiles intercepted, and also drones being directed at Iraq and diplomatic quarters in Iraq today as well.
Yeah, and Jemana, to your point, it's a reminder, isn't it, of the complexity of opening up the Straits of Hormuz, which raises the question as to whether or not this oil reserve move, potentially by the IEA, that's what the markets have to look to now, because the reopening of the Straits of Hormuz seems to be a longer-term prospect. Oil is up again in the sessions today, Jemana. How significant is a potential move in terms of this? Is potentially a record level of reserves being released onto the market? We're not there yet, but that is what the IEA is nodding to.
Yeah, that's correct. I mean, it all depends on the number of barrels that the IEA decide to release to the market, and there's strong hints that they are working towards something. The Wall Street Journal reporting that if they do so, it would actually surpass the Strategic Petroleum Reserve release that we saw post the Russia invasion of Ukraine back in 2022. Back then, the U.S. released 180 million barrels, and so Bloomberg Intelligence did a quick back-of-the-envelope analysis of the numbers, and even in a situation where, let's say, the U.S. released 180 million barrels and then the rest of the G6 decide to release a similar amount, so that takes you to about 360 million barrels spread out over 6 months. That amounts to about 2 million barrels a day. How much of the oil is that going to compensate for the seaborne oil that would have gone through the Strait of Hormuz? Well, the estimates there range from 18 to 20 million. So yes, it accounts for a small sliver of it, but not for the lion's share of the oil or oil related goods that are not being able to transit through the Strait. So I think the perspective from the market here is it may provide a bit of a short-term solution, a short-term support in terms of easing some of those physical constraints, but it's most definitely not a long-term solution.
And indeed, we have Brent back above $90 a barrel, up 3.1%. Jemana, thank you so much for the update. Jemana Basecchi there, Bloomberg's Horizons Middle East and Africa anchor. Well, let's take a look at what else we're watching throughout today. We have the OPEC monthly oil report at 12:30 p.m. London time, the US CPI print. Of course, this is before the Middle East war broke out. We also have the Fed's Michelle Bowman speaking. And then at 3 p.m. London time, the ECB's Isabel Schnabel will be speaking before at 6 p.m. London time, the US federal budget balance. But let's get a view on today's big market moves with Skylar Montgomery-Koning from our MLive team. So, Skylar, you've been talking about this. The IEA move maybe not enough to bring down oil prices sustainably. What would it take that is not in Iran's power, that the rest of the world can do something about to bring down oil prices sustainably?
I think the issue is there's not an obvious alternative supply that can bring that down. As Jimena was saying, it's 400 million barrels is the max of what the U.S. is talking about in terms of release from the SPR. And that's from a number of countries. And that covers 20 days of supply that comes out of the Strait of Hormuz. And so we're in day 10, 11 of conflict. So, 10 more days. And that's completely gone already. And so I think the issue is there isn't another place that you can get that supply from. Even if you just look at the Strategic Petroleum Reserve for the U.S., that's only 415 million barrels. And so there's just not anywhere else you can really get this. And that means the risk is that the energy prices stay elevated from here.
And so there's a bit of a sticking plaster then, perhaps, over what is really the problem, which is the closure of the Strait. We have inflation data out later from the US. Will the market just brush this off as entirely backward-looking, or could there be detail in there about any pre-existing inflationary pressure that was building in the States before this war? How are you looking at that?
I'm looking at the risk being very much skewed towards bond selling off on the print, because there's actually this very interesting relationship between G4 inflation surprises and the change in the energy sub-index of BCOM. And what you see is that when energy prices rise, the inflation surprise index rises as well, which is quite weird because energy is a real-time variable. You know when it's going to rise and when it's going to predict inflation.
Yeah.
But it still very much surprises economists. And I think we're seeing that now as well, as in you haven't seen big revision to inflation expectations or inflation consensus numbers. And I think that's partly because maybe their view is that the war won't continue. But certainly the risk is tilted to the upside. And if you have inflation that was much more persistent ahead of this big inflation surge, that's even more worrying. And energy has been a down drag on inflation. So that's definitely going to shift. And that just means that if you get a higher inflation number today, that you're more worried about the future of inflation, and that means bonds can sell off. Whereas a lower inflation number, you just go, well, that's backward looking, and I'm now focused on energy.
The kind of asymmetric function on the back of the CPI number later today. Bonds are being punished again today, and partly that seems to be on commentary we're getting from ECB officials. Where are we in this journey in terms of central bank response to this inflation shock?
Yes, I mean, the commentary is definitely shifting more hawkish. I think the hard part for investors is that you're getting whipsawed by headlines, right? And everything is moving together. So bonds are all selling off together, they're rallying together, but you can see some kind of mispricings that I'd talk about in terms of, if you look at the ECB, hikes have been brought into this year, whereas for the Fed, what you've seen is cuts have been pushed out. So they've been pushed out into 2027. And because you have central banks looking for hiking cycles as soon as, or markets looking for hiking cycles as soon as the end of the cutting cycle comes, that means the market's not looking for a U.S. hiking cycle until 2028. Now, it seems very unlikely that the ECB is going to hike it and the Fed's going to follow 2 years after.
Okay, a conversation that we will pick up on at a later date. Skylar, thank you very much. Skylar Montgomery-Koning from our Markets Live team. European equity markets then on the back for the defence sector weighing. Retail doing well on the back of Inditex. The brief is up next. This is Bloomberg.